Hey there, Jim Flouse here. I have some information I wanted to share with you that potentially could save you thousands when it comes to filing your taxes next April 15th. You know, I work with a lot of real estate agents across the country, self-employed taxpayers, small business owners, and one of the things that I have found over the years is a big mistake they make. They treat their accounting and their taxes as if it's a once-a-year event. Now, what do I mean by that? What I mean is they're running so hard building their business, generating revenue, getting paid, managing projects, putting out fires, that when it comes to the record keeping and the tax liability for their income, it's pretty much an afterthought. I once heard someone say, you know, business owners sometimes don't just push record keeping to the back end of the stove. Sometimes it just gets pushed off the back burner altogether. And I mean, I get it. I was a small business owner before I started my accounting business 12 years ago, and then when I started this business in accounting, I was probably a lot like you. I was just, you know, looking to get customers and get paid. Build the business, build my client base, get the work done, get paid. Then find some more clients, and then do some more work, and then get paid, and on until you sit down and you're filling out your tax return and you're going, wow, how did this happen? Let me give you an actual story from last week. I had a real estate agent, young agent in the office, and in 2016, it was his first full year in real estate. And in his first full year, he generated about $145,000 of gross commission. Very strong first year. Of course, he was all consumed with just getting business in and getting listings and getting houses sold and getting paid. But then when it came time to pay the IRS, his bill was about $48,000. Now, if he had not treated his accounting and his taxes as just an end of the year or once a year event, he would have been able to do some proactive planning to dramatically reduce his income taxes. So if you're in this same position, let me share with you 3 things you can do right now to fix this. Number 1, between now and the end of the year, get your record keeping together. You know, most of us have big holes in our record keeping. Maybe we just throw stuff in a shoebox or put it into an Excel file, but we really don't know what is our net income? What's my taxable income? So get your records together and then take that box of receipts or that Excel spreadsheet or, hey, even the QuickBooks file that you've been piddling with, send that to an accountant. Have them put together an actual profit and loss statement based on IRS rules and standard accounting standards. And then, second of all, have them sit down with you and review with you what's deductible and what's not. Where do you stand? What is your projected tax? And really just kind of get a bottom line number. Know your numbers. The third step is ask that tax professional to give you some proactive advice on things you can do between now and the end of the year that are going to dramatically reduce your taxes. Are you set up correctly? Do you have things classified properly? Are you aware of what's deductible? Can you shift some income to other years or other people? What can you do now to dramatically save on taxes next April? And I can tell you sometimes it's as simple as buying a piece of equipment or buying a new car. I had a taxpayer a couple of years ago, had a big income, their first full year in business, and we went out and we instructed them to buy a particular vehicle that qualified for a massive tax deduction at that time. So it can be a very simple solution. It may be the end of the year, but it's not too late. If you have a tax professional that you trust, get together with them, get your profit and loss together, project your taxable income, and ask for some proactive things you can do to reduce your taxes. For more information on what we do for our clients, you can visit anchoraccountingandtax.com, and I'm Jim Flouse. Thank you.